10 main investment terms, or what a novice investor needs to know. The first part. Broker. A broker is a professional participant in the securities market whose activities are monitored by the state and the central bank. With it, you can buy and sell securities, trade currency, and other financial instruments. In other words, a broker is an intermediary between an investor and an exchange. With the help of a broker, an investor has access to securities on the exchange. The broker charges a small commission for his services, and they are all different. The broker will also pay income tax for you if you manage to make money on the stock exchange. Securities. This is all that can be bought on the stock exchange. A security is a document that gives you the right to own a financial instrument. The most common securities are stocks and bonds. In fact, securities are electronic records that confirm that you are the owner of something. Stocks. This is one of the most popular types of securities. Each share is a piece of a company. For example, buying an Apple stock, you buy a stake in the company. Initially, everything works like this. The company earns money, but one day it becomes not enough. It wants to get more funds for its projects. To do this, the company comes to the stock exchange and sells a part of itself in small pieces. Each piece is one share. People buy shares. The company receives money for development. Then the shares continue their life. People buy and sell them among themselves at different prices on the stock exchange. Dividends are the money paid to you by the company whose shares you own. This is a part of the earned profit that the company is ready to give you. The amount of money you can receive per share is determined in advance. Depending on how many shares you have, you will receive as much money in the form of dividends. But companies are not required to pay dividends, and those who pay usually make up a dividend policy. In it, companies tell how much they are going to pay their shareholders, whether they are going at all, and how often. Bonds are the second most popular types of securities on the stock market. When you buy a bond, you lend money and get interest for it. You can lend money to the same companies or the state. In the first case, these will be corporate bonds, in the second, government bonds. When a company issues shares, it sells its shares. When it sells bonds, it borrows money from investors. It often happens that one country has issued both stocks and bonds in the stock exchange. Government bonds are often cited as an example as an alternative to a bank deposit. They are considered a reliable financial instrument because the probability of bankruptcy of the state, unlike companies, is less. But the interest that the state can pay you for the fact that you have lent it money is higher than the bank. Thanks for watching. Subscribe to the channel. Wait for the second part.